Okay, let's unpack this. It is Friday, January 30th, 2026. The earnings season is in full swing, and usually this is the time of year we stare at spreadsheets, talk about interest rates, and try not to fall asleep.
Right.
But there is one report that dropped today that feels different. We are doing a deep dive into ExxonMobil's Q4 2025 earnings. And before you reach for the skip button because you think this is just going to be about gas prices, stop.
Please stop, because if you skip this, you are missing, maybe the biggest pivot in modern industrial history.
Right. I was reading through the transcripts and the supplemental data you sent over, and I kept checking the header to make sure I was reading about an oil company. We have molecule management, we have cube drilling, and we have a plan to turn carbon emissions into bridge foundations. This isn't a standard energy report. It feels more like a blueprint for a material science revolution.
That is exactly the right way to frame it. Look, on the surface, yes, Exxon beat earnings expectations. The stock is up. Everyone on Wall Street is happy. But if you are listening to this to understand the future of the global economy, you have to look past the top-line revenue. The real story here is how a legacy giant, often called a dinosaur, is using massive data overhauls and, advanced chemistry to completely redefine what it means to be an energy company.
So that is our mission for this deep dive. We are going to unpack the numbers, yes, but we're also going to get into the how. How are they squeezing more oil out of rocks that everyone said were drying up? What on earth is Proxima? Why are they having serious meetings with the biggest tech companies in the world about artificial intelligence?
And ultimately, we need to answer this so what, because Exxon is signaling that the energy transition isn't an end to their business model, it's just a new product line.
Let's start with the scoreboard, though. We have to ground this in reality. Today is earnings day. How did they do against the consensus?
They beat the street, and they did it comfortably. Adjusted earnings per share came in at $1.71. The consensus from the analysts was sitting at $1.63, so a solid beat there. On the revenue side, they pulled in $82.31 billion.
Whoa.
The expectation was around $78 billion, so they cleared that bar by over $4 billion. The market reacted well. The stock closed around $141.43.
Those are just massive numbers. $82 billion in a single quarter is GDP-level money for some small countries.
It is.
But what really jumped out at me in the report was the cash flow and what they are doing with it. They are handing money back to shareholders at a rate that is, frankly, hard to wrap your head around.
It is staggering. In 2025 alone, they did $20 billion in share repurchases.
That's billion.
And if you zoom out and look at the last 5 years, they've returned $150 billion to shareholders.
$150 billion.
To put that in context, that is roughly the entire GDP of a country like, say, Kuwait or Hungary. It is an immense amount of capital.
Now, I have to play devil's advocate here for a second. I think a lot of listeners hear buybacks and they think, okay, the company has run out of ideas.
Right.
If you were giving all the cash back, does that mean you aren't investing in growth? Is this some sort of liquidation strategy in disguise?
That is the classic criticism, isn't it? That they are starving the future to feed the stock price today. But if you look at the capital efficiency metrics, that whole narrative just falls apart.
How so?
They aren't just cutting checks. They are fundamentally changing the cost structure of the business. They reported $15 billion in structural cost savings to date.
When they say structural, what does that actually mean? Is that just firing people, or is it something deeper?
It's deeper. Structural savings mean permanent changes to how the machine runs. It's not just deferring maintenance or freezing hiring because oil dipped to $60.
Yep.
It means they have re-engineered their processes so they simply cost less to run forever. And here is the kicker stat that puts that $15 billion in perspective. Their captured savings are greater than all other international oil companies' IOCs combined over the same period.
Wait, combined. So you take Shell, BP, Chevron, Total, put them all in a bucket, and Exxon saved more cash than all of them put together.
Combined. That is what the data says. And that level of financial discipline is why they have an industry-leading return on capital employed ERC of 11%. Their nearest peer is 2 full percentage points behind them.
Whoa.
So to answer your question, they aren't starving the business. They are just running it so much more efficiently that they have billions left over to give back to you.
Okay, so they are lean, I get it, but you still need to sell a product. Let's talk about where the actual oil is coming from.
Right.
Because they kept using this phrase, advantaged assets, and 2 names kept coming up over and over again, the Permian and Guyana.
These are the twin engines of the current cash machine. Let's start with the Permian Basin. This is the big U.S. shale play in Texas and New Mexico.
Now, for years, I have been reading headlines about peak Permian.
Hmm.
Analysts saying the sweet spots are drilled out, the wells are going to get less productive, the boom is over.
And CEO Darren Woods was incredibly blunt about that on the call. He explicitly stated there is no near-term peak Permian.
Really?
They hit a record production in Q4 of 1.8 million oil equivalent barrels per day, and they expect to exceed 2.5 million beyond 2030.
Okay, but how? I mean, if the geology is what it is, how do you get that much more out of the ground? This brings it to the tech. I saw mentions of lightweight proppant. It sounds like something you'd buy at a hardware store, but apparently it is a game changer.
It is a massive deal, but we need to explain it simply. In fracking, you blast water and sand down a well at high pressure to crack the rock. The sand, that is the proppant, it wedges into those tiny cracks to keep them open.
Right.
If the cracks close, the oil can't flow.
So the sand is basically a doorstop.
Exactly. But normal sand is heavy. Gravity pulls it down, so it might only prop open the bottom part of the crack, or it just doesn't travel far enough into the fracture network.
Okay, that makes sense.
Exxon is deploying a new lightweight proppant. It is a ceramic material that is stronger than sand, but much, much lighter. Because it floats better in the fluid, it travels deeper into the cracks and props open more surface area.
So better sand means more oil from the exact same hole in the ground.
Significantly more. They used it in 25% of their wells in 2025, and they are aiming for 50% by the end of 2026.
Wow.
It is a perfect example of a marginal gain, maybe a few percentage points per well, but when you apply it to thousands of wells, it unlocks billions of dollars in value.
The other term they threw around for the Permian was the cube, which sounds incredibly sci-fi. Can you break down the cube development strategy for us?
Yeah, this is a logistics and engineering shift. In the old days of the shale boom, it was a land grab. You drill a well here, move the rig, drill another one over there. It was fast, but really inefficient. Cube drilling is manufacturing. They set up a massive pad on the surface and drill multiple wells, sometimes dozens from that one spot. They fan out in different directions and hit different layers of rock all at once. They are attacking a cubic volume of the earth.
So instead of poking one straw into a drink, you are putting 20 straws in at the same time, all reaching different parts of the glass.
Precisely. Now, the catch is that it takes a long time to set up. You have a lot of upfront cost and months of drilling where no oil is coming out yet.
Right.
This leads to what Wall Street calls lumpy quarterly results. It looks like production is flat, and then suddenly, boom, everything comes online at once. It requires patience, but it maximizes the long-term recovery of the resource.
And it seems like that patience is paying off in Guyana, too.
Yeah.
That is the big offshore play. They mentioned the Yellowtail project came online ahead of schedule.
Way ahead. Gross production there is roughly 875,000 barrels per day. But the stat that blew me away was about their FPSOs.
The big floating ships, right?
Right, floating production storage and offloading vessels. These are massive floating factories. Exxon said the first 4 of them are producing 100,000 barrels a day above their initial investment basis.
Wait, explain that. They build the ship to handle a certain amount, and it's doing 100,000 more than that every day.
Yes. Usually you build a facility to its nameplate capacity and you hope it runs at, 90% efficiency. Exxon builds these, learns how they operate in the real world, and then debottlenecks them. They tweak the engineering, the flow rates, the pressure to squeeze out extra capacity without building a whole new ship.
That is basically free oil. The capital's already spent.
Exactly. And that is why they call it an advantaged asset. Since the capital is sunk, that extra oil has an incredibly low cost of supply. It doesn't matter if global oil prices crash to $40 a barrel. These assets still print money. That is the fortress they have built.
Okay, so we have the oil flowing, but I want to pivot to something that sounds incredibly boring, but might be the most important part of this entire report, the internal revolution. They spent a surprising amount of time talking about ERPs.
I know. Enterprise Resource Planning Software.
Yes.
Usually when a company starts talking about ERPs on an earnings call, it's because something went terribly wrong. But here it is a victory lap.
They dropped a stat that made my jaw hit the floor. They said they previously had 10 different ERP systems. And get this, 65 million lines of custom code. They said that was the highest of any SAP customer in the world. That sounds like a digital nightmare.
It is a Frankenstein's monster. Imagine trying to steer a global ship when your navigation systems are in 10 different languages, running on custom software that was written 20 years ago, and nobody remembers how to fix it.
Yeah.
That was the federated model Exxon used to run. Every country, every business unit did its own thing.
So if you wanted to know how much you were spending on, say, pumps globally, you probably couldn't find out.
Not without weeks of emails and spreadsheets. So they nuked it. They moved to a single data construct, one system to rule them all. And the fallout is dramatic. 97% fewer profit centers and 70% fewer cost centers.
97% fewer profit centers. That sounds like they just deleted the entire middle layer of bureaucracy.
That is essentially what they did. They streamlined the corporate nervous system. But here is why you should care. It's not just about saving money on IT support. It's about being able to use artificial intelligence.
Right, because you can't run AI on messy data.
Exactly. AI needs clean, structured data. By standardizing everything, Exxon can now apply AI at a global scale. They gave the example of marine logistics. When you have one data set, an AI can look at your entire global fleet of tankers and say, reroute that ship, slow this one down to save fuel, swap this cargo with that one, all in real time.
Right.
You simply cannot do that if your shipping data is trapped in 10 different siloed systems.
So the boring software upgrade is actually the prerequisite for them becoming a tech-enabled company.
It's the foundation. Without it, the rest of the strategy just falls apart.
Which brings us to the part of the report that felt the most futuristic, the science section. We need to talk about Proxima and graphite, because this is where the molecule management thesis really comes alive.
This is the pivot point. For 100 years, the business model was simple. Find carbon, dig it up, refine it, and sell it to someone who burns it.
Which creates CO2.
Right. Now, as the world moves to decarbonize, Exxon is asking a different question. What if we don't burn the carbon? What if we use the carbon atom as a building block for materials?
Enter Proxima.
Proxima is a new thermoset resin system they have developed, and they are using it to manufacture rebar.
Rebar, like the metal rods you put inside concrete to make it strong?
Yes, but this isn't steel. It is a polymer-based material derived from their petrochemicals. It is lighter than steel, it is stronger, and crucially, it is corrosion-resistant. It doesn't rust.
That is huge for things like bridges and roads.
It is. And they claim it offers a 40% improvement in installation efficiency compared to steel because it's so much lighter to handle.
And they are actually using this. It's not just some PowerPoint slide.
No, they are eating their own cooking. They mentioned using Proxima rebar in the foundation for a new overpass at their Curl site in Canada. They are proving it works in heavy industrial conditions before they scale it out to the broader market.
And then there is the battery tech.
Ah.
ExxonMobil, the battery company.
Well, let's be precise. They aren't building the battery cells like a Panasonic or a Tesla. They are staying in their lane, which is materials. They have developed an advanced battery anode graphite.
And the claims they made were pretty bold.
They were. They said their graphite allows for 30% faster charging, up to 3% higher capacity, and this is the big 14x battery life.
4 times the battery life.
Uh-huh.
If that is true, that changes the economics of electric vehicles completely.
It does. And think about the philosophy here. Graphite is carbon. Exxon knows how to manipulate carbon molecules better than anyone. They are taking a feedstock, maybe a byproduct from a refinery, and turning it into a high-value component for the green economy.
That is the molecule management. You aren't an energy company. You are a carbon manufacturing company.
Correct. It turns a liability carbon emissions into an asset structural materials and energy storage. It is a massive hedge against the decline of gasoline demand.
They also touched on lithium. We know the price of lithium has been crashing lately. Are they backing off that project?
Not backing off, but they're being very clever. They acknowledge the difficult pricing environment, but their strategy isn't just to pump brine out of the ground. They are focusing on the processing technology. They want to be the lowest cost producer in the world. They are basically saying, we won't scale this up until we prove we can do it cheaper than anyone else. It goes back to that advantaged asset mindset. They don't gamble. They engineer margins.
Now, speaking of energy demand, you can't open a newspaper in 2026 without reading about AI data centers. The hyperscalers, Google, Microsoft, Amazon, they need power, and they need a lot of it.
It is the new gold rush. AI models are incredibly energy hungry, and more importantly, they need that power 24/7.
Which is the problem with wind and solar, right? A
Right.
data center can't go offline just because the sun went down.
Exactly. If a cloud server goes down, the digital economy stops. They need 99.999% reliability. And CEO Darren Woods confirmed they are in serious substantive conversations with these tech giants. giants.
So what is the solution Exxon is pitching?
Mhm.
Because these tech companies have net zero goals. They don't want to just burn coal.
The pitch is gas-fired power generation paired with carbon capture and storage, or CCS.
Okay.
You burn natural gas to get that steady, reliable baseload power for the servers, but you capture the CO2 emissions right at the smokestack and inject them underground.
So the tech company gets reliable power, and they get to claim it's low carbon.
Right. And Exxon is arguably the only company that can do this end to end. They produce the gas, they have the capture technology, they own the pipelines, thanks to that Denbury acquisition a few years back, and they have the geologists who know where to store the CO2 safely forever.
They predicted a commercial deal or a project announcement by the end of this year, 2026.
Exxon powers the cloud. It is a headline waiting to happen. It connects the old economy of gas with the new economy of AI.
Let's zoom out to the map of the world for a second.
Hmm.
Geopolitics. There's a very specific, somewhat delicate mention of Venezuela.
The White House watch list?
Right. Venezuela has the largest oil reserves in the world, but it has been a geopolitical no-go zone for Western companies. But Woods brought up the Trump factor.
He did. He noted that the Trump administration is focused on stabilizing the region. Exxon signaled that if the political situation stabilizes and the legal framework allows, they are willing to send a technical team in.
Why does Exxon want back in? Isn't it a mess down there?
It is, but the geology suits them perfectly. Venezuelan oil is heavy, it is thick sludge, incredibly hard to refine. And who is the world leader in refining heavy oil?
Exxon. Because of the Canadian oil sands.
Exactly. Their pitch is basically, if the politics get fixed, we are the only ones with the tech to turn this cheap, difficult sludge into value. It is a long shot, but they are keeping a toe in the door just in case.
And finally, let's just touch on LNG liquefied natural gas.
Yeah.
We've been hearing about the Golden Pass terminal for what feels like a decade.
And it is finally happening. Startup activities are underway. They expect the first LNG to ship early in March 2026. So imminent.
In Mozambique.
Yeah.
That project has been stuck in force majeure due to security issues.
It has. But again, look at the discipline. They didn't just sit there waiting. They used the downtime to re-engineer the project. They claim they have driven the costs down significantly. They expect a final investment decision, an FID, later this year. They turned a delay into a cost-saving exercise.
So let's pull this all together. We have record production, 4.7 million barrels a day. We have high-tech sand and cube drilling in the Permian, maximizing the yield. We have a cleaned-up digital nervous system that's cut out the bureaucracy. And we have this pivot to materials like rebar and batteries.
And we have a changing of the guard. We should mention this was the final call for CFO Kathy, who is retiring. Neil Hansen is taking the reins as the new CFO.
Right, a new voice on the calls, but the strategy seems totally locked in.
It does. And I think the key takeaway for you listening is this. Stop thinking of Exxon as just an oil company. They are a chemical engineering company that is agnostic about the end product.
So if the money is in gasoline, they make gasoline. If the money's in battery anodes, they make anodes.
As long as they can use their scale and their technology to get a higher return than anyone else, that 11% ROCE, they will chase the molecule. They don't care what the molecule does as long as it pays.
So here's the thought I want to leave you with, and it is something to really chew on. If ExxonMobil can successfully turn carbon from a waste product emissions into a structural material like rebar or energy storage like batteries, does the energy transition look less like a cliff edge for them and more like just another product line launch?
That is the trillion-dollar insight. If they crack the code on carbon materials, they are not going anywhere.
We will be watching that stock ticker and those cube drills closely. A huge thank you for listening to this deep dive.
Thanks for having me.